Welcome back to the video series, Essential Terms You Must Understand to Invest in Real Estate. Today, we are going to talk about what is cap rate or capitalization rate. Maybe many of you have heard of it, maybe many of you haven't. Welcome back to the channel, guys. I'm Dr. Johnny Walker. I'm a successful endodontist with multiple dental practices, as well as a self-made multimillionaire in real estate investing. On this channel, we teach dentists and high-income professionals on how they too can achieve financial independence. Let's get started. Now, what is cap rate? Cap rate is called also capitalization rate. This is just jargon, just like in dentistry, and MOD and amalgam is something that might sound very foreign and complicated to somebody who doesn't know, but to a dentist, this is just simple terminology. Real estate terminology is not anything different. It's not overly complicated or difficult to understand, especially if you have the ability to achieve a degree in dentistry. Now, the simple formula for the cap rate is the net operating income divided by the market value. Now, why is that important? I'll tell you. So first, let's define some terms. In the preceding video to this, we discussed what NOI is in great detail. But NOI basically is when you take the gross income from a property, subtract the expenses associated with running that or operating that property, and the number that's left over after paying all your expenses is your net operating income. Market value is what someone would pay for the asset or property in the marketplace. By dividing the NOI the property produces by the market value gives you the capitalization rate or the cap rate, which is a very common real estate metric. Now, what it basically tells you is the rate of return from a real estate investment property. Importantly, the cap rate does not provide you a total return on investment, but it will indicate for you how long it would take you to recover the initial investment on the property. It is a useful metric to also compare different investment opportunities, but it should not be the sole basis for whether you invest in a property or not. Let me just make that clear right from the beginning here. Okay, again, a capitalization rate is just another tool indicating the financial health or potential of an investment. Nothing more, nothing less. Cap rates should be used in conjunction with other metrics such as IRR or ROI, which is internal rate of return or return on investment. These are all terms that are also going to be discussed in this series, and also your debt service coverage ratio, another video that is in this series of videos. So let's take a real example with numbers. Now, what I've done is I've taken this formula, cap rate equals net operating income divided by the market value, and transposed it to solve for market value. So now the relationship is net operating income divided by the cap rate equals the market value. In the previous video, we talked about what net operating income, and it has a direct proportionate effect on the value of a property. The higher the net operating income means the more income you have after you've paid all your expenses, more the property's worth. That makes sense, right? Cap rate, on the other hand, it has an inverse relationship. So when cap rate goes down, market value goes up. Let's take an example. Let's say that the net operating income from this investment property is $10,000. That's fixed. Okay, we've maximized the income that this property can generate, and it's $10,000. Now, just by changing the capitalization rate at 10% is worth $100,000. What happens if the cap rate goes down? Cap rate at 7.5% means the property is worth $150,000. Still same property. Say the cap rate drops even further to 5%. Now that property is worth $200,000. Even though the net income hasn't changed, it's still $10,000. But the cap rate has, from 10% to 5%, is halved, and the value has doubled. So you can see that directly inverse relationship. This is an example. If the cap rate is above 10%, then the value is worth $83,000. So the value is even below the $100,000 mark. So capitalization, as competition in a marketplace increases, say for example in Houston, Texas, where we just bought a 300-unit property. In Houston, Texas, there's a lot of competition of investors trying to buy a scarce amount of apartment building product. When there's fierce competition for a scarce product, what happens to prices? They go up. The more you pay for the property when the net income isn't changing means the less that you're making on your invested capital. So that's why when cap rates go down, values go up. People are willing to pay more for proportionately less cash flow. On the other hand, investments with high cap rates imply higher risk. right? So the result is that if an investor is willing to take on higher risk, they should get a higher rate of return on their money. So a property that has a cap rate of 12% versus a cap rate of 5%, somebody is willing to pay $83,000 for a riskier investment. Say, listen, these are different asset classes. So if somebody was investing in an amusement park, they would expect that their rate of return should be higher because they're taking on more risk. They might pay for $10,000 of net income, they might be willing to pay $83,000 for it because it's a riskier investment. Now, somebody buying a primely located apartment building where there's a ton of demand and people are fighting to rent your property, you're willing to take a 5% cap rate and willing to pay more for that 5% cap rate. So now you're paying $200,000 for $10,000 of net operating income. Here you're paying $83,000 for $10,000 of net operating income. One is not necessarily better than the other, but one, it tells you the amount about the amount of risk. So the lower the cap rate, generally speaking, the lower the risk, but also the higher the value. Hope that helps. Click on the next video of essential terms. We're gonna break down all the terms that you need to know. I mean, I suggest you go through one day when you have time, just go through and listen to this entire series of videos, binge watch it. When you're done, you're gonna understand all these terms. So when you're looking at an offering and they're throwing these terms at you, IRR, cap rate, NOI, you're gonna have a knowledge of, hey, what is this? I actually know what this is. They can't throw me off. They can't confuse me. Because remember, the informed investor always does better than the uninformed. We'll see you on the next video, guys.